let's
More
go.
Morning, everyone. Good morning. Welcome to B&M's first virtual Planning for Care seminar. I'm Angela Hunt and I'm the Head of Sales and Marketing at B&M Homes. I should point out straight away, I'm wearing a mask, and that's because I'm working from the office today, and it's B&M's policy that we wear masks in our work locations at the office, as well as our care homes. Our seminar today is being delivered by the lovely Nicky, who is a SOLLA Accredited Care Funding Specialist. Welcome, Nicky. Nicky's from Eldercare Group. Just to give you a little background on B&M Care before I hand over to Nicky. We've been building and operating care homes since 1975. So we have over 45 years of knowledge and experience of caring for older people, and specifically older people that live with a dementia. We've got 26 care homes in our group, and we operate over Hertfordshire, Buckinghamshire, Berkshire and North Hants. Now I completely understand the concerns that families are facing at the moment if you're considering respite or long-term care for your loved one right now. It is scary times. It's challenging and scary times, but I'd like to reassure you that the actions that B&M Care have been taking across all our homes, we've taken the responses and the actions that we've taken to these awfully unprecedented times are proving to be effective. We're still welcoming new residents into our homes. We're conducting COVID-safe viewings and families and visits as well in COVID-safe circumstances. Most importantly, the well-being and care of our residents remains our #1 priority. So we're still here to answer your questions or concerns about care for a loved one. Please stay in touch with us and stay connected. You can follow us at bmcare.co.uk. So today's seminar is offered as part of our ongoing strategy to share our knowledge, training and advice with our families and customers and the wider community. Seminar is expected to last around 30 minutes. Is that right, Nicky?
Yeah.
And there'll be an opportunity to ask questions and book a private call at the end. So I'm going to hand over to Nicky now and mute myself, and it will disappear from your screens for a short while, and we'll catch up at the end. So enjoy the seminar. Over to Nicky.
Thanks, Angela. I'm just going to do my whizzy screen share, one hopes. There we go. Hopefully, I can't get the thumbs up from Angela now because she's disappeared, so hopefully you can see this. It says to me I'm screen sharing, so I'm going with that. So as Angela says, yeah, about 30 minutes the presentation this morning. Don't worry about kind of writing copious notes or trying to memorize it all, because all the content I'm covering today is in our Paying for Care guide, which we can email out to you on request, or you can download from our website. I'm going to have all the contact details on display as we go through. Obviously this is a generic presentation, and that's really difficult. I know that each of you watching will have your own specific scenario, so apologies for its generic nature, but we'll try and cover all the key areas. But if something's missed, or you want some bespoke advice about your particular set of circumstances, as I say, get in touch with us afterwards, not a problem at all. So it's a really big topic to try and fit into 30 minutes or so. So I've broken it down into 3 key areas really that we get asked about. The basics really of who pays for a stay in a care home, because unless you've experienced this before, there can be quite a lot of assumption that perhaps it's free. I think maybe if you're watching this you'll realise it's not. So we'll cover the basics of who actually pays for care. The issues around whether a property has to be sold or not. I think there's a few urban myths out there around properties being taken and so on and so forth when someone moves into care. So let's dispel those myths this morning. And in the absence of any clear government policy now on fixing social care, certainly till next year at the earliest, let's actually look at whether there is action that one can take oneself to limit perhaps what the cost of care might be. So how somebody might actually cap their own care costs. So that's the plan for the presentation. But before I go into that, it would be rude, I think, of me not to properly introduce myself. So Nicky Cave, but the company is Eldercare, and we are a firm, as Angela mentioned, of SOLLA accredited independent financial advisors, but we specialise just in care fees planning, care fees funding. So whilst we might have all the qualifications that allow us to talk about pensions and mortgages and protection, it's not something that we do all day, every day. We're advising families on how care funding works and what the solutions might be for them. So in the same way that I wouldn't feel comfortable talking about those areas, it's probable that many financial advisors that do a lot of mortgage work or protection work or even investment work might know nothing much about care fees funding. So it really is very niche, and we'll often work in partnership with those financial advisors that don't necessarily have the experience that we do. So the business was actually set up by myself in 2007. So we don't quite have the B&M Care longevity, but the business was set up as a result of my own family's experience of the care system and my grandparents moving into a care home many years ago. We got absolutely no advice, didn't realise there was advice to go and get. Their property was sold, all the money was used, and it wasn't until later in my professional career that I realised there were alternatives that we were unaware of. So really, I guess the business was set up as a bit of a personal soapbox to try and make sure that other families weren't in the dark to the extent that we were. So whilst we're here at the invitation today of B&M Care, and we've worked with them for a long time, we don't have any commercial link. This is just about getting the right advice to the people that need it. So we're not connected in any way to any care provider, but we do work with many. Because we're having money conversations with people, you would hope, and we are directly regulated by the Financial Conduct Authority, so you can see us on their register. And whilst I'm talking to you today from a kind of grey, miserable looking Bishop Stortford in Hertfordshire, and obviously a lot of the B&M connections are in Hertfordshire and surrounding counties, it doesn't really matter too much. Our advice, even pre-lockdown, was delivered predominantly by phone, post, email, and of course more commonly now Zoom. That's really because we appreciated that there were several siblings perhaps involved in any decisions, and if you have conversations face to face with somebody missing, that's when things can get lost in translation, as it were. So this way, there's a very, very clear audit trail of everything that's discussed. All our recommendations are in writing. So actually the lockdown situation hasn't changed our business model from that perspective. So I mentioned that we are a business, we're not a charity, but actually about 90% of the calls that we take and the work that we do is pro bono. We don't charge for our initial consultations or even for doing research of certain financial solutions. So there's some rationale behind that I won't bore you with, but from your perspective, if you decided to instruct us to implement a particular financial product for you, there would be a charge at that point, but you would know all about it, you would have agreed to it in advance, and that's quite a long way down the road. So the key for now is just to understand any initial consultations are at our expense and not yours. So I'm going to go back to that original question on the agenda around who actually pays for care in a care home. And I'm going to try and keep it really, really simple. It obviously is more complex than I'm going to cover today. But if I were to simplify it, I would say there are three main funding streams for a stay in a care home. A person is either funded by the local authority, social services, the council, it's all one and the same place. They could be funded by the National Health Service, or failing that, they would be treated as a self-funder. And I suspect the majority of the audience today will be in that latter category, but let's check and let's take each one in turn. So looking first at that local authority funding, The most important thing to note here really is the order of events. So everybody is entitled to have a care needs assessment. Now, quite how long social services would take to carry one out at the moment is another matter, but a care needs assessment might be useful literally as a starting point, even for somebody who thinks they're not going to get any financial support from the local authority, purely because it draws up a care plan as such and might make recommendations of the sort of environment somebody needs to be in. The key is, however, to get any funding from the local authority, you have to meet their eligibility criteria. If the local authority don't think a person needs to be moving into a residential care setting, then regardless of what follows next, they don't have to pay. So there will be some variance from local authority to local authority as to what that eligibility criteria looks like, but that is the gateway, and that really should be happening before any conversations about the money. So the start question should not be, well, does your mum have a house, for example? That should follow after the care needs assessment has been carried out. Okay, so care needs assessment first, then the financial assessment. Now, what's fundamentally the financial assessment looking for? Well, at its most basic level, it's looking to see whether you have assets or capital above or below a certain limit. And that limit in England and Northern Ireland currently is £23,250, much more generous in Wales at 50,000. That 23,250, by the way, hasn't changed, I think, now for 9 years. If you're a couple, then it's that capital limit each. Okay, so if you have below that limit and you've met the eligibility criteria, that's when the local authority would work out what they will pay for someone's care. What counts towards capital, though? If I were being very, very flippant, I could just say pretty much everything, but there are a couple of notable exceptions. As I say, if we're looking at a couple, then it is half of any jointly owned capital, and there is definitely a case for separating out the balances in any joint account, not messing with the percentages, the 50-50 ownership, but just separating out. So 50% of your capital, if you're going into care, that's assessed, but your partner's is not. And obviously 100% of anything owned by yourself would be, therefore 100% of anything owned by your spouse would not. Okay. Your property is also included unless a spouse or relative over 60 lives there. There's a couple of other exceptions as well, but they're the two common ones. And it is quite troubling that we hear of couples who think when one of them goes into care that somehow the property is taken into account. It's not. It has an invisibility cloak over it for the entirety of the time the spouse remains living there. It's not retrospective. Otherwise, if the spouse were to later move into care or were to pass away, at that point, the property value comes into play, but otherwise not. The relative over 60 is an interesting rule because we do have more, I think we have more multi-generational families cohabiting. But if mum moves out to a care home and the week before daughter age 62 moves in, then that won't count. Okay, that would be something that the local authority might call deliberate deprivation, which is a horrible, harsh term, but they would say that you only did that to take advantage of the rules. It's not a genuine cohabiting arrangement. So as I say, there are other exceptions depending around whether there's a will, trust owning half the property and so on and so forth, but that's perhaps too much to get into today, but we can help advise if that's a concern to you. The other capital that isn't included is if somebody holds an investment bond, a particular type of investment bond that has a life insurance wrapper as part of it. Again, it's really easy for us to spot what one of those looks like. For yourselves, if you were acting as attorney for somebody, and you were looking through their paperwork, it would be probably addressed to Mr. and Mrs. So-and-so lives assured. It might refer to unit values going up as well as down, and it might be with companies such as Aviva, Standard Life, Scottish Widows, rather than Barclays, Abbey National and Lloyds Bank. That's usually how you would define it. But again, the timing when the investment bond was set up would also be key. So if somebody's only ever had money in national savings and a month or two before a move into care took place, they put everything into an investment bond, the local authority might still include it. So it's applying some common sense there, really. So that's the sort of capital above or below and what counts, but income does count as well, and that's actually often overlooked. So it's important to note that if, again, in the married couple scenario, the spouse who is not going into care, they are allowed to retain up to 50% of any private pension. But otherwise, when the local authority is doing the calculations, they are going to expect the individual for whom they're paying to contribute their own state pension and at least half their private pension towards that. So we need to clear that up, because we did talk to families who think, right, this is how much we're getting from the local authority, I can top that up with my pension. That's not the case. It's a combination of the two. So it's effectively the local authority topping up what you have as a pension to a certain amount. Now, the local authorities generally have a limit on what they will pay. They're not supposed to have an arbitrary figure set out already. It is meant to be assess somebody's needs and then pay for those needs. But in reality, they will have contracts already in place with a number of care homes, and they will restrict the amount of money that they're going to pay to the fee that they've agreed with that home. But there always, if you are state funded, there always has to be a care home place on offer that meets needs, that is funded by the local authority with no requirement for a top up. Okay. Third party top ups may be required, but only if you are choosing not to accept that particular local authority place and you are choosing, for example, to go to a different, perhaps more expensive care home. In that latter scenario, a third party top up absolutely will likely be required. So again, just for information, as most of the audience I imagine will be self-funders. So that is our social care system that's means tested. You may have heard then of our second stream of funding, which might be available, which is not means tested. So this is where the National Health Service would fund somebody's care. And as you might imagine, that's going to be directly linked to your state of health. So in layman's terms, if you would ordinarily be receiving your care perhaps in hospital, it would be free. There's no reason why it should be charged just because it's in a different setting. However, it is generally, the words that are used are intense, unpredictable, complex healthcare needs. And we can again signpost you for more information if you think that's something a relative might be eligible for. And we certainly work with partners that can help in making claims. But you do have to be really quite poorly to get your care fully funded by the National Health Service. It might be something somebody doesn't qualify for initially, but might qualify for later in their care journey. There is a level beneath continuing healthcare where you get a funded nursing care contribution that's running at just under 184 a week. But again, you do need to be having some nursing care as part of your care package. So if you are not funded by the local authority, have too much money, and you're not funded by the NHS because you're not deemed to be poorly enough and meet their criteria, then you are a self-funder. And pretty much the only positive news I can give you this morning is that you would be eligible to either continue to receive or to make a claim for attendance allowance. Now, again, the information about this is in our guide. It's a non-means tested state benefit, doesn't need to be declared on a tax return. There's a higher and lower rate. It's a very long form to complete to claim it, and the difference between the two is whether or not you need at least 20 minutes worth of attendance during the night time. So if there's bathroom visits need accompanied, you want to be putting on the form that there are at least 2 10-minute visits or 3 7-minute visits would be my tip of the day, as it were. So a lot of people think attendance allowance stops when you move into a care home, not if you are self-funding. So it's a help rather than a significant contribution, but everyone is entitled to it, should claim it. So I said that was the sort of only good news for self-funders. There is some other state assistance available, but only if you fit in the category of owning a property and having less than the capital limits that we talked about earlier. So if you're moving into care permanently, leaving the property vacant and have under those thresholds, then the local authority has to ignore the property for the first 12 weeks. Disregard it for the first 12 weeks. That just means you get treated as if you are a local authority funded individual for those first 12 weeks. That means the local authority can limit what they pay, but they can't restrict who they pay it to. So if you've chosen a particular care home that's not on the local authority list, the local authority can pay the amount of money that it would have paid one of the homes on its list to this home, and this home can ask for a top-up during that 12-week period, and that top-up can come from the person, not a third party. It's the one exception to that rule. But most importantly, any money that the person gets from the local authority during those 12 weeks doesn't have to be repaid. Again, we're getting conflicting stories of what people are told by social services. It categorically does not have to be repaid. If at the end of the 12 weeks the property hasn't been sold, which is quite possible, then what? For people with limited savings, I hear talk of equity release. Well, in my experience, there's only one provider that would do an equity release mortgage on a vacant property where the owner is no longer occupying. So equity release generally doesn't work as an option, doesn't work for this particular scenario. It might work for care at home, but not moving into a care home. But you can borrow money from the local authority until the property is sold, or not even bother selling it, rent it out and borrow what you need from the local authority. All local authorities have to offer it. Yes, there is interest payable, but only on what you're borrowing, and there's a chance the property value may go up during that time, and that would more than cover any interest that's built up. There's a setting up fee, of course, but it, in my opinion, is reasonable and comparable to any mortgage lender. So the local authority can refuse a loan if there's a very low value property, or if it's a property with any problems in terms of being built on a floodplain, all the normal things that would stop a mortgage company lending, that would apply. And if there already is a mortgage on the property, they can't do it. But a lot of people would meet the criteria for this. But again, you've got to be poorly enough to meet the care eligibility criteria of the council. So if someone's moving into care purely because they feel they'd benefit from the social side, then they might not be eligible for this scheme for that reason. The key difference between this and the 12-week disregard is that the local authority can cover the full fee, so they can lend you whatever you need. You're a self-funder, they can lend whatever is needed, not restrict it to that local authority rate, and it follows on from the 12-week disregard. And then you can pay it back during the person's lifetime if the property is sold in their lifetime. Otherwise, the loan does need to be repaid on death. Okay, so it's just a scheme. Get advice on it. We can talk you through it, but most people don't know about it. That's the key. So for the self-funding families that we talk to and have talked to over the years, they generally have two main concerns. They don't have a crystal ball, and if you don't have a crystal ball and know how long your loved one will be in the care home, how do you cash flow forecast? How do you work out what you can afford and if you've got enough money? And the other concern is, well, what would happen if the money runs out? So obviously they're beneficiaries of a will, that they're not now going to have anything to inherit. But more importantly, it's understanding whether the person would be able to stay at that particular care home if the money did run out. So they're the two primary concerns that are shared with us. And there is a solution to both of those concerns in certain scenarios. So it's not a panacea. It won't always work, even if a family like the sound of it, it might not actually work in practice. But the reason I do what I do, and the reason the business was set up, is because 85% of self-funding families don't even get to hear about it. They don't know about it. And I think that's wrong. So I'm not here to product push or try and sell something. I'm here to tell you about it, give you the basics, then you as a family can decide whether it works for you or not. Going back to what I was saying about my family, we were certainly in the 85% when my grandparents went into care and had absolutely no idea we had any options. So let me tell you about it, and then you will no longer be in the 85%. So there is an option to cap costs yourself when moving into a care home. You can actually insure care home fees. Now, people find that a little strange of a concept because you couldn't insure a car after it's been involved in an accident. You couldn't insure a house just after the bathroom ceiling has collapsed, but you can insure care home fees after a move into care has taken place. You actually can't insure care costs ahead of time. You used to be able to, but you can't anymore. So it is a reverse insurance that you insure after the event and it starts paying out immediately. So the technical term for it is a care fees annuity, but the word annuity often conjures up bad images of pension products that represented bad returns. It's a similar concept, but it is very, very different because pension annuities, people were expected to draw their pension for 20, 30 years. A care fees annuity, the average age of our annuitant for starters is 88. So they are not expected to be paying out, the insurers are not expecting to pay out for 20, 30 years. And the person is by definition going to have some health issues. So it's not the same as a retirement annuity, but the concept of paying a lump sum up front in return for a guaranteed tax-free income, that's where the parallels are. So with the care annuity, every case is different. We as an advisor work with the family to understand what the funding gap is. So how much are the care fees? How much income do they already have? What's the shortfall? And then we apply for quotes for the shortfall. The insurance companies will collect some information from the care provider, and one of them at the moment is writing to the GP as well, plus any information that the family can provide, and every case is different. Every case will be priced according to the information that's received. They're fully portable, so if somebody did buy one for care at home or was in one care home, moved to another, they just take the income from the plan with them. They can index link the income to allow for fee increases, but of course that's not mandatory. They might cover fee increases from the money that they have left over, completely optional. And there are other options we discussed with the family around capital protection. At least two of the providers at the moment, for example, have a COVID guarantee, which means that if a death did occur within a year of buying one of these policies and the death certificate says it was in any way related to COVID-19, then 100% of the money is returned to the estate, less anything that's already been paid to the care home. So there are options. Of course, it's a gamble, and I do use the word gamble quite sincerely because the downside of this is you pay the money, the person doesn't live as long as the insurer predicted, you don't get money back unless you have taken some of these additional options. So it's a gamble around life expectancy, but the people that buy these policies are buying that peace of mind that it's mum's money for mum's care or dad's money for dad's care, and if some is lost, so be it. They're buying that peace of mind. You would really, in the current climate, want to ask this question as well around the products, which is what happens if the insurance company that provides the plan goes bust. Well, these plans are fully protected by the Financial Services Compensation Scheme. That's the scheme that covers you for 85,000 in the bank or building society, but on these policies you're covered 100% of the income. So pretty secure, to say the least. So as I say, the reasons people do it is that peace of mind, so that they are not applying later on to the local authority wondering if they'll meet the cost of that care home or not, and ideally it's ring fencing some of the estate to pass to the beneficiaries. That's when it works both, but when it meets both these points is when it works best. We really struggle to second guess whether a family will find this a viable option or not. So our report simply gives the facts, the figures and the explanation, and the family makes the decision from there. If an individual were to buy one of these and later on qualify for NHS funding, then the money from the plan is paid into their bank account directly. It would at that point suffer a small tax charge, but we are talking nominal rates, 2 or 3% usually from the cases I've seen in the past. So as I mentioned earlier, we don't charge for doing this research. We are posting out a pack and you're returning it, and the insurance companies are doing the work to get the underwriting done. So it doesn't feel appropriate to levy a charge there. And of course, the quotes could come back costing more than you have, your loved one has, or that you'd be prepared to spend. And so our experience is that that's not helpful to charge families for something that they can't have, even if they wanted it. We would, however, charge an arrangement fee if a policy purchase goes ahead. So you could argue that's a slightly a cross-subsidy model, but when you enter the process, you don't know whether you'll be one of the people that will buy or won't. And if you don't buy, you probably won't want a bill. So that's the model that we offer. Now, just to wrap this up for you, just so you understand a little bit more about how niche this area is, there are very limited insurance companies that offer these plans, and you can't, as a member of the public, go direct to them. But I'm going to share with you the names just so that you realise that they're quite big brand names. Aviva, you I'm sure will have heard of. Just, you may not have heard of unless you have a pension or equity release type of product with them. Legal & General, you certainly will have heard of. Now, those three companies, their care annuity products are available through any advisor that has a particular care qualification. You have to hold a particular qualification to advise. We actually brought the Legal & General product to market about 2 years ago. They ran their pilot with us, but they are now available through any broker, any care broker. The fourth company, however, National Friendly, they approached us in the spring of last year to pilot and bring their product to market, and they're really happy with how we advise, how the launch has gone, and they're not looking to make their product available through any other financial advisor in the UK at present. So coming to us means you get 4 quotes. Anywhere else you will get the 3, and we never know which of these 4 companies is going to offer the best terms. It's not the case that Aviva are always the cheapest for people aged 83. It doesn't work like that. They really do jumble around, and we never know who's the cheapest. So it's imperative to get quotes from all 4. So the one question in closing here that, apologies again for rattling through, I know I talk fast, it's a very big content area. So the advice at Eldercare Group address there is the best one to fire off any immediate and urgent questions, or give our free phone number a call. The website there, you'll be able to download the guide, or family members can do the same. And because I haven't answered the question in true politician style about how much would one of these actually cost, then we've built a rough guide calculator on the website. It works for people over the age of 80. That doesn't mean people under 80 can't get quotes. It just means the data is a little more misleading. So if the person is over the age of 80 and we know how much the care home fees are likely to be, how much income they already have, those are the 3 bits of information you put in. It will then give you a rough ballpark figure based on estimates, based on quotes that we've obtained for other people over the years. It clearly can't be a figure that you would make a decision on, because it can vary up or down quite a lot, but it at least gives you that I've got absolutely no idea. It gives you the answer to that. So there's quite a lot of other helpful information on there. Please feel free to have a look around. And as I say, apologise, it's been a very speedy run through, but please do get in touch if you have any questions about your specific situation. So I'm going to pop back, closing my screen. Angela, you can unmute and video yourself to say hello. Hello.
Everyone.
We're back on. So that wraps us up, I think, unless there's anything that you wanted to pick up on.
Oh, thank you very much, Nicky. I've listened to your seminar several times over the years, and I think I pick up something new every time I listen to you. So thank you very much for coming on board. And for those of you listening there, you may be relatives, residents, already have loved ones in a home, or just seeking advice. You can pick up information from our homes, but go directly to Nicky if you have some specific questions and want to progress with an inquiry. Thank you.
Oh, and I'm sure we'll be doing these again if the demand is there. Brilliant.
Keep an eye on our website, everyone. Thank you.
Yeah, brilliant. Thanks, Angela. Thanks everybody for attending.
Thank you very much.
Close
We'll sign off now. Thank you.
Bye-bye.
Bye-bye.